Hi everyone, and welcome back to the Peregrine Capital Hedge Fund Trading Academy. My name's Alan Yates, and I'm head of distribution at Peregrine. And today we're going to be talking about fees. I think the thing to say up front is obviously there is somewhat of an image around hedge funds and our fees, and that we're often considered a very expensive investment vehicle. And while I'm not going to refute that, what I am going to do is hopefully talk you through how the fees are made up, what portion of those fees are applicable to your clients, and then very importantly, I think why you still get value for your investment with us, even at those fee levels. So to start with, I think in a most basic sense, there are, from a management perspective, there's two elements to a hedge fund fee. The first is the traditional management fee, which you will be very used to and aware of with all of your normal unit trust holdings. And that's really the percentage fee that's charged as a percentage of NAV, regardless of what happens in the fund on an annual basis. Now, the fees for us and the fees for other hedge fund managers in the industry, I think on that element are very comparable to traditional long-only active managers. I mean, we're definitely not playing in the passive space here. We're not looking to bring the fees down to as low as possible because we are active managers, because we are managers that are doing fundamental research, because we are managers that are hopefully employing the absolute best and brightest PMs to manage this money. It's not a tracker sort of scenario, and therefore there will be a management fee, and that management fee is, however, very comparable to other active managers in the space. The second part of the fee is the performance fee, and I think this is the part that is often very new to investors with us and new to investors in hedge funds. That's not to say that these fees do not apply in the long-only space as well. I mean, there's certainly some very large balanced funds in South Africa who apply the performance fee methodology, but it is something that I think you'll find is standard practice in hedge funds, and therefore something I want to spend some time talking about today. So if I look at our management fee, so that's that base fee. For us, our funds, our pure hedge fund is at a 1% base fee. Our high growth fund is a 1.5% base fee. So I don't think either of those are particularly miles off where investments that you would be used to and using already in your practice. If we then go on to the performance fee element, how is a performance fee calculated and what is a performance fee? So the performance fee really is the percentage of positive performance achieved by the fund that Peregrine Capital is entitled to receive as the fund manager. So this fee differs in principle to that base fee because it is dependent on that performance. So I mean, as the name suggests, if we perform well, we get a good fee. If we don't perform well, we don't. The performance fee, I think very importantly, can only be charged when the fund has generated positive performance that is new to that investor. So there are three elements to this. The first is to say to you, there's a performance fee. That's the inclusion rate on that performance. For Peregrine, and I think for many of the other hedge fund managers in the country, that's normally at around 20%. Then there are two other factors that come into play here. The first is what's called a high water mark, and the second is what's called a hurdle. And I'm going to run through all of those in the next couple of slides with you. So when we talk about the hurdle rate, what is that and how is that applicable? Hurdle rates are really if there is a benchmark that the fund needs to outperform. So often depending on the fund manager you're dealing with and depending on what they're trying to achieve in their fund, the hurdle rates will differ. But often the kind of standard one in the industry is cash. So what that means is that the fund has to produce positive performance above what cash has generated, and then we'll be able to, the fee will be calculated on that outperformance portion. So it's got to get past the hurdle. So first of all, it's got to be obviously positive performance. Second of all, it's got to be above the hurdle, and then lastly, it's going to be 20% of whatever that outperformance is. Then if I talk to you about what is a high watermark, and now this is something that I think you'll find is standard across all hedge fund managers and is absolutely, I think, very important to be in any hedge fund management fund setup. So if the fund doesn't have a high watermark, I think you would need to ask questions as to why that's the case. The appeal of a high watermark and the importance of the high watermark is very simply to say you never want to charge an investor a performance fee on the same performance twice. And so how do I explain that to you? Let me give you an example. If a fund goes from 100 Rand NAV to 110 Rand NAV, there'll obviously be a performance fee charged on that upside. If the fund then drops to 105 Rand NAV in the next quarter, and then progresses to 110 in the third quarter, there should not be a performance fee charged on that second leg up to the 110 because it's already been charged on the first one. So a high watermark in layman's terms is simply to say it is the highest NAV point ever achieved by the fund, and in order for a performance fee to be charged, the performance needs to be new performance, so above that high watermark that has been achieved. If we run through very quickly elements of this performance fee thing when we look at a client quote, and I think this is a super important part of what we have to look at and how we look at it, because this is something that can often get clients quite confused. So if you pull a quote from your list platform, or even you pull the TER, TRC from a fund fact sheet, it's going to give you a number, whatever that number is. Let's say it's 3.5% TRC or 3.5% TER. That doesn't mean that the client that's coming into the fund is going to be charged 3.5% for their investment with us. That TER is going to be made up of the management fee, it's going to be made up of the performance fee, and it's going to be made up of whatever transaction costs exist in a fund. Now, transaction costs, which we're all again used to, are any of the fees that are applied to a fund to trade in whatever securities they're in. So it's going to be brokerage will be a big portion of that. Whenever the fund buys or sells a security, you pay away a bit of brokerage, etc. The big point to make here that I think is super important, and when you're going out to clients, talking to them about the fee structure, is to say that performance fee that's shown either in the quote or on the fund fact sheet is the performance fee that was charged for the previous performance that has been experienced in that fund. Normally those figures are either on a 1 or a 3 year basis, but so let's use the 1 year basis as the example here. If we are looking at a performance fee that says the performance fee for this period was 2%, that's for that period. That is not what your client is going to be paying. Your client will only pay performance fees on the positive performance that your client experiences. So if your client experiences positive performance from there on out, they'll pay a performance fee. If they don't, they won't. And it's not going to necessarily be whatever that is on that quote. The performance fee is the 20%. So that's the number to think about. 20% of excess performance above the hurdle and the high watermark is what your client's in for. So if I run through a quick example for you to kind of wrap this all together and make sure that it's hopefully crystal clear, is to say, first up, if your client comes in and invests 100 Rand with us, and at the end of the period, that 100 Rand is now worth 110, the performance fee would be applicable on the 10 Rand that has accumulated in the fund. However, it's going to be applicable, first of all, it's got to be net of the base fee. So if the base fee is incorporated in that number, so for ease of reference, let's say we actually made 11 Rand profit on the 10 bucks, base fee was 1 Rand, so his performance there after the base fee is 10 Rand. But let's say the hurdle did 5 Rand over the same period. So you've got 5 Rand performance from the hurdle, you've got 10 Rand net of the base fee from the fund. The fund manager is then entitled to the 20% of that excess return, so between the 5 and the 10, which works out at essentially 1 Rand. So what would happen here at the end of the day, client will have received 109 Rand net returns, or 9% net return, and the fund manager would have collected 1 Rand as the performance fee. I think what's important about this is, first of all, performance fees align interests for us as a fund manager. We are rewarded if our clients do well. So the irony of this entire thing is that if your client sees a really large fee being charged on his portfolio, it means that we're doing our job. It means that we have produced that excess return, those exceptional returns that they're after, and are therefore able to make a performance fee on that as well. And this, I hope, gives you a good explanation of how these things work. The final thing I want to talk about is just transaction costs, because I think transaction costs are important. And it's something that you will find is probably a bit higher in a hedge fund relative to a traditional long-only fund. Why is that the case? Well, I think for two reasons. The first of all is to say that when we as fund managers are looking at transaction costs, these are variable costs that are being incurred by the fund as we go in and out of positions. So if we are being more active at any point in time in the cycle, you'll find that those transaction costs will be a little bit higher. But transaction costs as a percentage of the overall cost of a fund are normally relatively low. But most importantly, transaction costs mean that we are actively managing that portfolio, which is what our clients are paying us to do. So we are actively either protecting on the downside, putting positions in place that we think are going to benefit investors in the future, etc. And therefore, a transaction cost fee in these funds is going to be a little bit higher or on average might be a little bit higher than traditional long-only funds, because we are active managers and we're trying to generate that alpha for our investors. So to summarize for you, three major costs that are involved here. One is obviously that base fee, very similar to traditional long-only funds. I don't think that the pricing is really out of whack in that space. The big one, the new concept for most clients, is the performance fee. But I think the thing to take away here is to say clients will only pay that performance fee on the performance they experience in the fund. They will not be paying performance fees on past performance. They will not be paying performance fees on performance they did not experience. So when they pull up that quote and you see a TIC or whatever the case may be that's higher than your traditional fund, I think the important thing to say to your clients is very simply, that is backward looking, forward looking. You as the client will be in for a performance fee only if this fund manager performs. And so therefore there is that alignment of interests. So at the end of the day, we do well when clients do well. And I think that is actually a major benefit of these funds. Thanks very much for joining me.